Welcome to our reading on accounting shenanigans on the cash flow statement. Now, the background for this is that the cash flow statements have become far more important, especially in the US post-accounting scandals like Enron, for example. Now, the idea is cash flows are far harder to manipulate than maybe earnings. Okay, so let's look at our first learning outcome that asks us to describe the reasons for investors to assess the quality of cash flow statements. Now, of course, the misconception for investors is that you cannot manipulate cash flows at all. In reality, the total of the cash flows is very difficult to manipulate. Now, remember, the cash flow statement shows the change in the cash year to year, and it classifies it into our three classifications: cash flows from operations, cash flows from investing activities, and cash flows from financing transactions. Now, the total of those three is the change in cash, and that change in cash figure is very easy to audit. All the auditors need to do is times the market price, the share price at that date, minus the exercise price, which of course is the price that the employees is paying via the stock option. And this difference between market price and exercise price saves the company's tax. So they're going to pay lower tax when the options are exercised. And if we're paying lower tax, that's going to boost our cash flow from operations. Again, the issue is, whilst there's a boost to CFO, that is unsustainable. You can't continually keep your CFO at that level. You would need those tax savings to be incurred every single period. So again, it's a one-off boost. Now, the last little thing we look at in our cash flow manipulation reading is buybacks to offset dilution. Now, often when a company has employee stock options, what they'll do is they will buy back shares to stop dilution of earnings per share and stop dilution of the existing shareholders. Okay, in other words, they go into the market and repurchase shares before the employee stock options are exercised. Now, let's have a look at our example here. Our company's moved into the market before the date of exercise and repurchased shares costing it $24,000. Then the employee stock options are exercised, and the proceeds the company raises from that exercise are $20,000. Now, overall, that means the cost of these options, the net cash outflow of these options, is $4,000 to the company. Now, the key point is US GAAP treats that $4,000 as a cash flow from financing. And the reason it does, essentially, is that the share repurchase, when you buy back shares, that passes through CFF, making it smaller, and the cash they receive on the exercise of the stock options, again passes through CFF, making it higher. So, in other words, this net effect of $4,000 is felt through cash flow from financing. Now, we would argue that the true economic substance of this $4,000 is that it's a cost of rewarding our employees, i.e. it should be part of employee compensation. Now, we know that employees' salaries, wages, etc. pass through the income statement and pass through cash flow from operations. So maybe this $4,000 should have reduced cash flow from operations, not cash flow from financing. So as a result, maybe the analyst would want to increase. So we'll increase our cash flow from financing by $4,000 and maybe decrease our cash flow from operations by $4,000. And that's the end of this rather short reading.